On Tuesday, I read an article, I think it was on Wednesday. It was up on the Zero Hedge website, and it was basically handicapping the election. And this was I think it was a senior economist at Bank of America. Although I've seen other now Wall Street houses have a similar view on the election as this guy from Bank of America. But he basically laid out four possibilities for the election. So, first possibility is Donald Trump wins. Now, what happens to the Senate? I mean, the House is not really in question. We all know that the Democrats are going to maintain control of the House. So there isn't even a scenario that would factor in the Republicans taking back the House, because that's not going to happen. So that's off the table. But the Senate is in play, and the Senate is currently controlled by Republicans. So either Trump wins and the Republicans keep the Senate, or Trump wins and the Republicans lose the Senate to the Democrats. Alternatively, Biden wins and the Republicans keep the Senate, or Biden wins and the Democrats take the Senate. So there are four possible scenarios. And so this economist from Bank of America was basically commenting on which scenario was best and which was worse for the stock market. And believe it or not, the scenario that Bank of America considers to be the best possible outcome, right? This is what you should be hoping for. If you are in the stock market and you want the biggest gains, what Bank of America says you should be rooting for is for a Democratic clean sweep. You want Biden to be president and the Democrats to take the Senate so that they'll have both houses of Congress. Now, why does Bank of America regard this as the best scenario? They regard this as an even better scenario than the number two, which is Republicans keeping the Senate and Trump keeping the White House. So that is considered the second best outcome of the four. And you would think that Bank of America would regard that outcome as better than the outcome where the Democrats take the White House and the Senate. Because after all, if we get that outcome, it is a certainty that we are going to have much higher taxes on corporations. And if the tax cuts were good for the stock market, the tax hikes have to be bad. It can't be good and bad, right? Tax cuts can't be good, and then tax hikes are also good. If that's the case, then neither of it is good. The reality is, yes, if you lower taxes on corporations, you raise after-tax earnings, and therefore you raise the value of stocks, which are nothing more than the present discounted value of their future after-tax earnings. So the Bank of America analyst knows that a President Biden and a Democratic Senate means significantly higher taxes on U.S. corporations, significantly higher taxes on the shareholders who own stock in U.S. corporations, which diminishes the value of those corporations to the people who own and buy stock. And there's going to be a lot more regulation. Corporate America is going to be bogged down with a lot of additional red tape in a Biden administration that it might not otherwise be bogged down with in a Trump administration. And complying with regulations costs a lot of money. It's expensive. It makes you less productive. That will show up in lower earnings. So despite knowing that a Biden win with a Democratic Senate means lower corporate earnings, higher taxes, more regulatory burden, that outcome is seen as better than Trump winning and the Republicans keeping the Senate. And the rationale is exactly what I was talking about on my last podcast. According to Bank of America, this is the best outcome for stocks because this guarantees the most amount of stimulus, right? What we want is no gridlock. We want the same party controlling Congress. And since there's no way the Republicans are going to get the House, the only way to have clear sailing, right, no gridlock at all, to have the most amount of stimulus go through Congress and get signed by the president is if we have Democrat sweep. And so even though the Democrats are going to raise taxes, this is still good for the stock market because this analyst realizes that the Fed and the stimulus trumps earnings, right? That earnings are secondary, that the main game is stimulus, right? That it's the Federal Reserve that is playing the music that everybody on Wall Street is dancing to. And so what this analyst is saying is we just need more of that music. The party is going to rage on if we get more stimulus, right? Regardless of whether or not the stimulus is good for the economy, who cares? All we know for sure is that the stimulus is good for the stock market and we want more of it. We want the outcome that guarantees the most stimulus, and that is a Democratic clean sweep. So this shows you that they realize that this whole thing is artificial when they're rooting for higher taxes because they don't even care about earnings, because what's more important is the stimulus, and we're going to get more stimulus under Democrats than under Republicans. And I tend to agree with that. But I actually think that from America, right, the worst possible outcome of this election is exactly what Bank of America says is the best we could hope for. A Democratic sweep, right? A blue wave that's going to drown the country. You know, that is the worst outcome for the dollar, right? The dollar is going to get killed. That stimulus, all the deficits that are going to be the result of no gridlock, that traffic is going to flow, meaning that red ink is going to flow. And so that is definitely the worst possible outcome for the dollar. Now, if you think a weak dollar is good for the U.S. stock market, then maybe you could make that case. And I would say that if the dollar is weak enough in nominal terms, sure, U.S. stocks will go up. I mean, that's one of the main reasons I'm not short U.S. stocks, because over time, I expect the U.S. dollar to lose more value than U.S. stocks. So why be short U.S. stocks when I could be long non-dollar assets that are going to go up by so much more than the U.S. stocks go down, or if they even go down at all? But of course, the worst outcomes as far as Bank of America is concerned is divided government. See, that's what they fear most. So the second to worst outcome, according to Bank of America, would be for Trump to get reelected and for the Democrats to take the Senate. Now, I think that is kind of a lower probability outcome in my mind, but that is considered to be the second worst. It's still bad for stocks because, again, there's going to be some divided government. You're going to have Trump still president, but he's going to lose the Senate. So it will be harder for Trump to get stimulus through a Congress that is completely controlled by Democrats, because the Democrats will have the House and the Democrats will have the Senate. But the worst possible outcome, according to the Bank of America, is where Biden wins, but the Republicans take the Senate. That's the worst outcome. They've said that's terrible. Stocks are going down because they believe that the Republicans in the Senate, even though the Democrats still have the House, the Republicans in the Senate will be able to disrupt the Biden agenda and will be able to block a lot of the stimulus from coming through. And so the Republicans will be able to use the Senate to slow down or derail all the stimulus spending. And that's supposedly the worst outcome. I mean, personally, and as I said on this podcast, we had better hope that if Biden wins, which he probably will, that the Republicans at least hold on to the Senate, because that's the only thing we got other than potentially the Supreme Court to kind of slow down this tide of socialism that's going to be rising under Biden. But those are the scenarios that Bank of America regards as the worst for the stock market because they represent gridlock. But for the economy, gridlock is the best we can hope for, because anything that slows down what government wants to do is a positive, because government wants to do harm. Government wants to damage the economy. So the extent that a divided government minimizes the damage, that's a positive. I mean, that's why Barack Obama didn't do even more damage to the U.S. economy than he did anyway, because the Republicans took back Congress, because the Tea Party, right, 2010. So the Obama agenda was substantially slowed down by divided government. Had he had a Democratic Congress the entire time, then a lot more damage would have been done. And so a lot more damage will be done if we end up getting Biden as the president and the Democrats controlling both houses of Congress. But, I don't think it's necessarily going to be good for the stock market. As I said, on my last podcast, everybody was convinced that Donald Trump, if he won, it would be terrible for the stock market. And they were wrong. The stock market did very well under Trump. Now the markets are convinced that if Biden wins, the stock market is going to go up. They're as convinced of that as they were that if Trump won, it was going to go down. So again, I think it could play out the same way. Biden wins, you get a very short-lived rally as the markets get what they say is good and what they think is good. And then just like with Trump, when people thought about it again and they said, Donald Trump, lower taxes, less regulations, what's so bad about that? And they bought stocks. This time around, they're going to say, wait a minute, Biden, higher taxes, more regulations. Maybe this is not as good as we thought. Maybe hanging our hat on stimulus isn't the best place to put it. Maybe we should look for something else. So I think you could see a sell-off. But again, the downside is always going to be mitigated by the Fed. But as the Fed mitigates the downside to the stock market, they intensify the downside to the dollar and to the overall U.S. economy.